Hello, I'm Remco Westermann from Media and Games Invest and would like to introduce myself and the company. And after that, hand over to Paul, our CFO. I studied economics in the Netherlands. After that, started working in the oil industry, then into consulting, strategy consulting, and after that, I did a lot of restructuring. Then had various management jobs in media companies, worked amongst others for Sonora, the Finnish telecom. In 2005, I founded Bob Mobile. Brought it to the stock market, managed the company for several years. It was a strong growth story. After that, in 2012, I had the opportunity to buy Gamigo from Axel Springer. It was a distressed gaming company. We restructured it. Running a buy and build strategy, but I guess we'll talk about that later. So I'll hand over to Paul. Thank you very much.
Thank you, Remco. My name is Paul Echt, CFO of Media and Games Invest. Studied law and finance, worked afterwards for a Silicon Valley startup company, did some equity fundraising there with the top management team of Shopgate Inc., learned quite a lot for the CFO role, were hired afterwards by UniCredit Bank for their newly formed tech team, where later stage tech companies are covered, and did some pre-IPO debt financing, worked also very close with the equity capital markets team there, and met Remco in 2017. There we refinanced the German bond of Gamigo AG with a UniCredit term loan. And in 2018, then there was an opportunity to join Media and Games Invest and also Gamigo as a CFO, and took the opportunity. Since then, we have actually accelerated growth quite a bit, have more than 100 million raised in debt and equity funding, completed more than 6 M&A transactions in the media and gaming sector. And I'm very happy to present today together with Remco the company, and also give a bit more market insights where we are today.
Yes, Media and Games Invest started with gaming. Gamigo was the first company that we acquired and when we started the growth with. But for gaming, user acquisition is very important. So we took the decision to also go into media, because media companies are the part doing media acquisition. So we talk about an extension of the value chain, because the part of the value chain that we get with media companies is much larger. So we buy media cheaper, and also we make more money with media if we use them as advertising in our games. Media industry by itself is huge. We're talking about $360 billion worldwide. For online and mobile media. It's growing over 10% year on year, and it has similar characteristics as the gaming market. We're also talking about consolidation. We're also talking about very technology driven. So those are things that we know from the gaming, and we see a lot of synergies. There's a big fit set between the two segments. There's economies of scale. Having media companies makes us buy media a lot cheaper. Much more know-how in-house. But on the other hand, also the media companies are profiting very much from the gaming companies, because in the games we have advertising spots and that are uniquely sold by the media companies. So also with that, they have a USP towards the competition.
From a financial point of view, it overall had a positive impact on the Media and Games Invest group. But let's start maybe with the team. As we have shifted everything to work from home, also to protect our employees. And this actually has worked quite well, as we have invested quite a bit in the last years into video conference systems and all these kind of things due to our global setup with more than 20 offices from Sao Paulo, San Francisco, until Tokyo. So we see also very strong efficiency gains within our work from home policy, and thereof could not be happier that the team take it really as it is, and is performing very, very strong. And looking at the revenue side, especially in the gaming segment, we see very, very strong revenue increase, and has also made the statement a few weeks ago already, where we saw 64% in new registrations and 90% increase in daily active users, and therefore also have now increased marketing spend as new user acquisition have become a bit cheaper and more efficient these days. So the return on invest is quite high. Looking at the media segment, we actually see some verticals which are declining, like travel, while other verticals like gaming, as we do, has increasing spend, and therefore media is quite stable in our case. And some revenue declines are overcompensated by the gaming part. And as such, we actually have a pretty crisis-proof business model, and also expect further strong revenue and EBITDA growth for 2020. Before I answer the question how this can leverage further growth for Media and Games Invest and also gamigo Group, I would like to point out the framework of the transaction. So we have been able to buy out the remaining minorities of gamigo AG for EV/EBITDA multiple of 7 times, while our peer group, based on 2019 numbers, have been valued at 30 times EV/EBITDA. So this transaction has created very strong shareholder value for the MGI shareholders, and was based on old commitments, and this also led to these deal terms. How this can leverage further growth for MGI and gamigo Group is mainly 3 things. So it's increasing speed, as we don't need the approval of the minority shareholders anymore. It's increasing transparency, as also the whole profit of gamigo AG belongs now to the MGI shareholders. And it also aligns interest within the group, as all shareholders now benefiting from an increase in the MGI share. Which also makes us actually very proud is that the family and friends shareholders, which have been on board since 2012 and received MGI shares, now have agreed on a 25 months lockup, which also shows their long-term trust into the company and the management. From our point of view, it depends on the business model. For a game development studio, it would, from our point of view, absolutely be too risky to use debt funding to cover the game development risk. But as we are driving a different business model with a very strong cash generation and a clear M&A predictable business model, it makes absolutely sense from our point of view to also use debt funding to finance M&A transactions, and also looking at peers like Stillfront, which was one of the more mature companies like us, I would say. We also see that they are also using debt funding. And actually, we feeling very comfortable having interest coverage ratio between 3 and 4, and thereof don't see it as risky to be a debt-funded gaming company.